Is it a meme stock, a bank stock, a high quality fintech stock that you should be loading up on? What exactly is SoFi stock, and is it a buy or a sell? SoFi went public via SPAC. It was a merger with Social Capital, the ticker IPOE, and it's been a bit of a mess. So if you would have bought it on that day, you're down 28% all time. Bruh. The stock did have a triple top around $22, so if you would have bought it at the top, you're down much more. Over the past year, SoFi is down about 21%. Year to date, down 22.3%. However, it's up almost 17% in the last 5 days.
Why?
Well, Ryan, I'm going to explain why. Is SoFi a bank? Well, technically, yes. You can see on your screen here, this is back in 2022 in January. SoFi received regulatory approval to become a national bank. So, of course, for the customer, this is a very positive thing. CEO Anthony Noto, in a quote here, says, with a national bank charter, not only will we be able to lend at even more competitive interest rates, this important step allows us to add to our broad suite of financial products and services to better be there for our members. The problem is that Wall Street wants to label SoFi as a bank and not as a fintech stock. And the thing about SoFi is it has so much to offer. Check out all the different services here: personal loans, mortgage loans, credit cards, insurance. Of course, you've got student loans, refinancing, even travel. This is a partnership with Expedia. And this is a rewards point system for flights, hotels, rental cars, and more. You can also save 10% or more on select stays and earn unlimited 3% cash back. But look at all of these products on your screen. For investing, active investing, automated investing, IPO investing, fractional shares, ETFs, IRAs. You've got your checkings and your savings accounts. You've got all these different loans, financial insights, including credit score monitoring, budgeting, spending, and so much more. SoFi is really your one-stop shop for personal finance. So why has SoFi stock been underperforming the market so severely? One of the biggest bear arguments since 2021 is that SoFi hasn't been profitable. But if you've been paying attention, you know that SoFi is now GAAP profitable. And so you're not going to see a PE ratio that's using a TTM or 12 months trailing, but you will see a forward PE ratio. Now we'll talk about valuation metrics later on, but it's important to note that one of the bearish cases for SoFi is lack of profitability, and that narrative has changed. Of course, I mentioned earlier that SoFi went public via a SPAC. And to be honest with you, all SPACs are essentially trash. People want to throw them in the garbage. Now, I do think there are a few SPACs that are worth investing, but a lot of them, they really are trash. And several have already gone bankrupt since the frenzy in 2021. So that does impact sentiment, and you can't necessarily change that other than with time and proving itself through growth and profitability. Now, during the first quarter of 2024, SoFi had a really strong earnings report. SoFi reported net revenue of $581 million. That's an increase of 26% year over year. The problem, though, is the loans, especially student loans, Biden with forgiveness plans, and so on. But even though SoFi grew 26%, the lending segment generated $325 million in revenue, and that was flat performance year over year. What do you think happens when interest rates go down? I'm going to show you a clip here from CEO Anthony Noto.
26% year-over-year revenue growth with really no growth in our lending business, which is a really strong quarter, and we're really pleased with how things have gone since then. We've came out of that quarter thinking there'd be 1 to 2 rate cuts and positioned our business to do that, which would give us still attractive revenue growth, maintaining profitability, but just as importantly, having a strong balance sheet to take advantage of when rates go down. I think the consensus view is starting to come into picture, and people believe we'll continue to get the data points on inflation, continue to see an uptick in unemployment, not too bad, and we'll have 1 to 2 rate cuts by the end of the year, which would be really positive.
If you haven't noticed, bank stocks have been on a tear. Now, this is the KRE ETF. This is the regional banking ETF. It's up 3.64% today alone, and up almost 14% over the past 5 days. You'll also notice the big banks like JPM and Bank of America have also been up 7-8% over the past 5 days. Now, part of that's earnings, but what else is going on under the hood? Now, it's really interesting. This next clip from CEO Anthony Noto was before what happened to Trump over the weekend.
Just a final question about politics, because I know the conversation about the presidential election is front and center here in Sun Valley. What outcome do you think would be best for the economy and for your business in particular? particular?
Well, I'll make an analogy. I went to West Point and I played football, and I want Navy to win 364 days of the year. But on that one day when they play Army, I want Army to win. And so I'd be lying to you and being, less than disingenuous if I didn't say our business would benefit from a Republican administration. There's more capital markets activity. There's more M&A activity. I want our country to be very strong and vibrant. And on one particular day, I'll be rooting for one particular party.
Now, before the events on Saturday even happened with Trump in Pennsylvania, the markets were leaning towards Trump winning this next election. And whether you want to talk politics or not, it does impact the markets and your portfolio. Instead of getting political and explaining it myself, I'm going to let Jim Cramer do it for me.
President Trump was not a big believer in financial regulation, or at least arduous financial regulation, which is great news for banks large and small, including JP Morgan, Bank of America, Goldman Sachs, and the two we own for the Travel Trust, Wells Fargo and Morgan Stanley. Wells just gave you a nice dividend boost. We got a lot of good dividend boosts, actually, after the close this evening. That's because it's in the wake of the stress test that all the banks passed, and you can presume that those dividend boosts would be even larger under a Trump administration.
Now, of course, you've been seeing a little bit of rotation in the stock market over the past several days with some of those mega cap tech, those winners, especially those AI winners, selling off, profit taking, and rotating more into natural gas stocks, bank stocks, those interest rate sensitive stocks, those stocks that are burning cash, the spec stocks, the small caps, and so on. Now, part of that's definitely the markets being proactive to what might happen with the election. And the market assumes that if Trump wins, that you're going to have less regulations, that you're going to have lower interest rates, and that's part of the reason why SoFi has been up nearly 20% over the past 5 days. The stock was pretty washed out in terms of sentiment, and you had over 18% short interest. So this is a bit of a short squeeze here. You already had some momentum, and then Saturday really was kind of the coup de grace, and that really started to put a lot of pressure on those bears. The thing that's actually really surprising is how well SoFi did without student loans. So when rates come down and student loans kick back in and you get refinancing, this stock certainly could take off.
The fact that we grew 26% year over year in Q1 with no growth in lending overall is a great indication that we've invested in other areas that are really paying off for us. And the response that we're seeing from consumers in our SoFi Money product with 4.6% interest rate, SoFi Invest product, as you mentioned, offering them alternative assets and now IPOs, we've seen a great response there, and it's allowed us to go after other growth areas and not be so vulnerable to the whims of where the political or winds are blowing as it relates to student loans. I will say this, we've done well with a high rate environment and uncertainty around credit. I'm really excited about what will happen when rates start to come down, and you can start to see the light at the end of the tunnel. When rates come down, we'll see a real pickup in student loan refinancing. Right now, there are people with rates at 7 to 8% student loans, but we only can offer them in the 6s. As rates come down, we can start to offer them in the low 5s and maybe in high 4s. So that business will pick up. Our home loan business had historically been a refinancing business. We've invested a lot in being able to do purchase home loans, and we're now seeing that pick up and gaining market share there. And we've recently made the decision on home equity lines to give people even lower costs of debt. So as rates come down, we'll see a real pickup, and as long as the economy is stable and inflation is stable.
All right, so all that information is great, but you want to know, is SoFi stock a buy or not? If you're holding it, do you keep holding it or do you sell it? Now, here's the bombshell question and a great response from Noto.
So you've mentioned various ways that your business is growing, but your stock is way down. Stock's down about 35% year to date, down about 19% since your last earnings report. I know that you have earnings coming up in a few weeks, so you're limited in terms of how many specifics you can share. But what's your message to investors? Why should they hold on when the stock is down so dramatically?
Yeah. The thing that we can control is our strategy and our execution. And for the last 7.5 years, our strategy has been consistent and our execution has been consistent. We've driven good, steady growth. When I joined the company, we had less than $300 million of revenue in 2018. Now we're over $2 billion of revenue. We weren't generating profits. We weren't generating positive EBITDA. Now we're generating both positive EBITDA and GAAP profitability. So I'm really pleased with what we're doing. In terms of the stock, I'm equally disappointed. I'm a big investor. Our employees are large investors. We've seen, and what we believe is happening, is that the group of fintech companies that have credit exposure has been really hit hard. And they've been hit hard because of the uncertainty around interest rates. When will interest rates growth peak and when will credit peak? And as I mentioned, we're really pleased with where credit's performed. We expected it to pick up a little bit, but it's within our tolerance levels. So good sign there. And as I mentioned, 1 to 2 rate cuts would be welcomed and moving in the right direction.
She also asked a great question about AI, artificial intelligence, and if SoFi is a player or not.
And what about AI? Will SoFi be the one to bring AI to retail banking, and will that really accelerate your results?
Yeah, there's a whole spectrum of technologies that we use every day to ensure that our product is safe, it's reliable, and we can be a trusted partner. Where we want to use AI is to fortify those areas, but we also want to use it to answer 3 questions every day. Because this is a financial show and we operate in a financial world, people want to talk about interest rates and consumer spending. We don't spend a ton of time talking about the product, but we are a product company, and my vision for the product is that you open up SoFi every day and you go to your member home feed just like you would to your Twitter home feed or your Facebook home feed or LinkedIn home feed, but we answer 3 questions for you in a personalized way. What must you do in your financial life that day? What should you do and what can you do? AI allows us to take all the data about you and everyone else and answer those 3 questions.
All right, so next we are going to look at valuation metrics, and we're going to look at a chart, and I'm going to tell you my thoughts if SoFi stock is a buy, a sell, or a hold. Before we do that, if you want to be a better investor, make sure you smash that subscribe button and the bell for notifications. And if this video was helpful, please return the favor and drop me a like and drop me a comment. I appreciate your support. So one thing to note right out of the gates is that SoFi is going to be reporting earnings here very soon, July 30th at 8 o'clock a.m. Eastern time. Of course, you always have to be careful with earnings because if something goes wrong on earnings, you could have a stock sell off, especially if it rips into the earnings report. And you can see the stock has been range bound for a couple of years. We had this triple top back in 2021. It sold off and it's just kind of traded in this range for a long time. And of course, if you look over the last 5 days, the stock is up almost 20%, but it's just a blip on the radar. One thing to definitely pay attention to, short float 18%, days to cover 4.6. So this short squeeze could continue and the stock could go much higher, but if buyers get exhausted, you could easily see pressure and this stock could go the other direction as well. So it's going to be very volatile. It's going to have very high beta. Another thing I want to point out here is this big dump in SoFi. This happened back in June 17th, and it was really the washout period for SoFi stock. So Qatar's investment authority disposed of its entire stake in SoFi Technologies. QIA sold 19.8 million shares of the bank and fintech company at an average price of $6.78. Ouch. Bruh. On June 14th, around the same time, Anthony Noto acquired 30,715 shares at $6.48, bringing his holdings, his total to 8.12 million shares. Oppenheimer, spotlight here, top buys and sells, ideas for small cap names. Now you're probably thinking it's going to be a top buy, but it's actually a top sell. Just something to point out. So a couple key catalysts that really washed the bottom out. I think this was partially technical. Also the fact that you have so much short interest and you've got that short squeeze, the market looking ahead, thinking about interest rates being lower, the election, and much more. So I said earlier that there would be a forward PE ratio, but not a TTM or 12 months trailing PE ratio. And you do have a forward PE ratio of SoFi 86.21. So that's certainly not cheap. You can see the stock is up another 5.87% today, trading at $7.76. Now, profitability wise, it does have impressive gross profit margin, 82.33%. But the profitability grade on Seeking Alpha is an F. Growth year over year, 34.6%. Forward revenue growth, 22.13%. That EBITDA growth really strong, 82.12%. Overall, an A rating. So valuation, forward gap PE, 86. Price to sales, 3.13. And oftentimes with banks, I've told you this before, you look at price to book. Now, SoFi was a pound the table buy when it got under 1 price to book. That was when it was $5 or less. And now it is a 1.33 price to book. For perspective, this is Bank of America, 1.24 price to book. And JP Morgan's forward price to book is 1.82, and it has half the revenue growth of SoFi. Of course, it pays a dividend and SoFi doesn't. So it's not that I necessarily want to use price to book to put a value on SoFi, but that's what the market's been doing. If the market decides to put a premium on SoFi because of the growth, you could see this go up to something like 2 price to book. And that would be significant upside. I'm not saying that's going to happen necessarily. I'm telling you what the possibilities could be. So going back to July of 2023, so this is about a year ago, the stock was $11.70 and it fell off a cliff, basically 50% cut to $6.41, bounced again to 10, and you can see it's been a channel just grinding down. So really since May of 2022, it's been range bound with a few exceptions where it's bounced up and it's basically rolled over immediately. So this S3, this Fibonacci S3 pivot point is down here at $5.52. It didn't get that low. It actually bottomed out just under this S1. And you can see it's popped nicely. This R3 is at $7.97. So you could start to see some consolidation soon because you are above all the moving averages, including this purple, which is the 200-day simple moving average. I think there's a decent chance this stock goes over $8 a share into earnings. If earnings are good, it's possible you see an extension to $9, even $10, and then all the way up here to $11.70, which would be back from July of 2023. So from the technical perspective, the stock looks strong. The question is, number one, what is it worth? Is it a fintech company or is it a bank? Are we using price to book or not? No matter how you slice it, it's definitely not cheap at an 85 or whatever 4P ratio, but it does have nice growth. And if earnings come in solid, this stock does have more upside. When rates come down, you will see an acceleration in growth in SoFi. I think it's positioned very well. As a long-term speculative investment for me, holding it 5 or more years, I think you'll do very well buying SoFi even at these levels. Now, our preference was $5 or less. Most of us own SoFi lower. And of course, earnings could make this stock roll over and go the other direction. You have to be really careful with that 18% short interest. But I do like SoFi stock long. I'm bullish, although I'm very realistic about what the company is. Just be careful of the pumpers out there telling you that it's going to be a $1 trillion company tomorrow. It's not going to happen. Appreciate you watching. Make sure you subscribe, like, and comment. Have a great rest of your day. Take care.